it seems like there's, I guess, growing fear that, Brent crude is going to go over $100 a barrel. Do you ever foresee that, I guess, occurring maybe in the next, 6 to 12 months? I'm putting you a little bit on the spot.
Oh, of course. I think oil could go to $200 a barrel in the next 6 weeks if the geopolitical world explodes. But look, there's also another very dangerous trend that we even hesitate to write about sometimes because you don't want to give people any ideas. But with the destruction of the Nord Stream pipeline, and now the destruction of this pipeline in Finland, this underwater natural gas pipeline, we are beginning to normalize the wanton destruction of critical energy choke points as sort of international tit for tat here. And that's very dangerous. And so you can imagine.
What is up, everybody? I'm back with another edition of the Macro Insights podcast, where I've got the most famous green chicken on the internet, recurring guest now, second time back on. So I appreciate you coming back, but let's jump right in, right? We have a lot going on, obviously, with, the Israeli conflict, the Ukraine-Russia war. A lot has changed since we talked 6 months ago. We're creeping up on $100 for Brent crude oil per barrel as well. So a lot of crazy stuff. It seems like we're in kind of an energy deficit. Maybe we were talking about, this winter coming up about being a potential energy crisis. So I'll leave it there for you, Doomberg. One, how are you? And two, are we about to hit an energy crisis coming into this last quarter of this year?
Brandon, great to be back. Doing great myself. Appreciate the opportunity to come back and enjoy another great discussion with you. As it pertains to the energy markets, there's at least 3 driving factors that you have to consider when you think about where oil and natural gas will go in the months ahead as we enter the winter of 23-24. First, obviously, and I think predominantly in the past week or so, and perhaps in the next couple of days or weeks, I think the price of oil is a proxy for the market's belief into whether or not the situation in Israel spreads beyond the current battles between the Israeli army and their incursions into Gaza, and specifically whether war spreads to include Hezbollah in the north and perhaps shortly thereafter directly interacting with kinetically into interactions with Iran itself. And I think if the war does spread across the Middle East, then you could see oil prices spike materially higher from here. But the market is kind of signaling that they don't think it will. And that's the only logical interpretation that we can draw from the fact that WTI is back in the low 80s now after spiking up when hostilities first broke out. The second thing we have to worry about is the fate of the Russia-Ukraine war, which is still ongoing, even if it has slipped from the front pages, much to the risk and chagrin of Zelensky in Ukraine, one would probably argue. I think he would admit. Generally speaking, when Putin feels enabled and empowered, energy prices tend to go higher. He's shown a willingness to use his ample commodity and energy resources as a geopolitical weapon, and who could blame him? I think we should assume that our geopolitical adversaries will behave in ways that optimize for them. And then the third, perhaps most important one, is how does the weather play out in Western Europe? Right now, if we look, I like to follow the seasonal trends in Frankfurt as sort of a proxy for Western Europe. I know there are hedge funds that have sophisticated, weather forecasting and tracking tools. I just look at the weather in Frankfurt. Gives me, 80-20 rule gives me a pretty good sense. And I would say so far in the early stages of late fall, early winter, things are tracking slightly warmer than average, if perhaps slightly cooler than last year, but we shall see. That's the big third unknown. So how the war plays out in the Middle East, in a connected way, how the war plays out in Ukraine and Russia, and then how the weather treats our friends in Germany and Western Europe are the 3 things that are top of mind for us every day when we open up our Bloomberg.
Yeah, and that's a great point, right? Obviously, there's a lot of, extraneous geopolitical factors, to say the very least. But it seems like the Fed, especially since the last time we talked, they were raising rates at, an astronomical pace. They've slowed down a little bit. But, Powell has kind of kept his foot on the gas when it comes to, higher for longer. He says that they're going to essentially, keep rates elevated. And it seems like that's kind of the lever that the U.S. is pulling, while as, the other countries in Europe, like the BRICS countries, are kind of pulling the energy side of things. Is that, in a sense, the way you guys see it over at Doomberg? Or, is there something, I guess, that I'm missing here, where maybe it's not necessarily like a full economic type of war?
I would say the two are related. I think Powell's need to continue hiking rates and or keeping them higher for longer, which is, I guess, the phrase of the day, is in fact interlinked and dependent upon the future price of oil and gas, because one feeds the other. In fact, many have argued that high interest rates are a driver of inflation in this cycle, because it does make the discovery and development and production of new energy sources more expensive. And we've never hiked rates at this pace with this much debt before. So perversely, the incremental amount of interest payments we're making are another form of fiscal stimulus, if you think about it. Sure, it's different than giving, blanket checks to everybody in the economy where the velocity of that money is high, but it is still cash deficit spending coming out of Washington that ends up in this case, the investor class's hands, but it does find its way into the market, if albeit with a lower velocity. And so I do think, like, we wrote a piece where the chart that we followed perhaps the closest when we're pondering the impact of the energy markets on interest rates is the price of diesel, because diesel, of course, finds its way into virtually everything that we consume. All physical products that find their way to the store shelf or get dropped off on your doorstep by Amazon at one point in their journey from the manufacturer to your home are transported by diesel. Diesel powers our cargo fleet, diesel powers our truck fleet, effectively diesel powers many of the homes in the US Northeast. And so if there's one chart that you want to watch to see how the inflationary pressures are tunneling their way into central bank considerations, we would keep a close eye on the price of diesel.
Yeah, and that is all fair. And how did, in a sense, like, how does this affect manufacturing, right? I mean, there's been rumors of China invading Taiwan for quite some time. Obviously, Taiwan's one of the bigger manufacturing when it comes to the semiconductor industry. And obviously, all these industries are, related in a sense, right? I mean, when we saw the pandemic break out and, essentially manufacturing and importing was slowed down, we saw, a bunch of the after effects here in the US with, used cars going up by astronomical amounts, appliances, all these kind of things being greatly affected. So in a sense, how does this, I guess, affect the manufacturing aspect of, things? Obviously, it seems like, countries like the US are trying to become more, I guess, independent and get away from more of, I guess, the global economy, but we're not there yet. So, I guess in a sense, how does that all affect everything?
It's interesting because we're getting very mixed signals. So we have many friends in industry, of course, and even just this morning, BSF was out with terrible numbers. Not sure if you saw. And our friends in manufacturing are signaling slowdown, recession, red alert, and yet the latest GDP print was, I think, 4.9% or something, well above expectations. And so we're honestly seeing very mixed signals. There's all this talk about China and the property crisis and a slowdown in China, and yet if you look at their energy demand, it's consistent with historical flows for a growing economy. And so it's pretty clear that the imminent recession crowd may have been wrong, but from a manufacturing sector, boy, I need to see more data. But our channel checks are that it's been a pretty rough October.
Yeah, and it seems like, I guess the needle keeps getting moved, right? I mean, 2 quarters of negative GDP growth was essentially the tracker for a recession before. They've changed that definition since then. And yeah, I mean, like you said, the recession has keep getting pushed farther and farther back, because it seems like, I guess, the consumer strength has kind of held true. But, it seems like there's a lot of, I guess, cracks underneath the surface. Obviously, unemployment is rising. Maybe the job numbers and the validity of all this data that they're presenting, to me, seems very, I guess, faulty. If you have some connections in the industry, if you're just kind of talking to some people anecdotally. So, I guess, what do you take of, I guess, the current situation that we're in, right? I mean, to me, it seems like we're in a recession, but when you ask some other people in the financial space, seems like we're still doing fine because the consumer is holding strong.
To go back to the very first question of our discussion, I think it all just does depend, frankly, on how events transpire in the Middle East. I mean, that is a dominant macro signal that will, cause several dominoes to fall. I mean, imagine if Lindsey Graham gets its way and the U.S. I think we have 4 aircraft carriers either there or on the way, which is a pretty historically large deployment, and it usually doesn't occur without those people getting into some action. Imagine Lindsey Graham gets his way and we start bombing Iranian oil facilities and the price of oil spikes. Well, then I think recession risk grows substantially. I think the U.S. economy can do pretty well, surprisingly well, at $80 oil and 5% interest rates. I would say if you told people a year ago that we would be at 5% interest rates, many people, including us, we would be the first to admit, would have assumed that the economy would have ground to a halt much harder than it has. It has certainly demonstrated more resilience. I mean, again, I think if you would have said we're going to go from 0 to 5% interest rates at the speed with which Powell did, many people would have been surprised and would have assumed that, quote unquote, something would have broken between then and now. And to be fair, it hasn't. And the people who are in the soft landing, no landing camp have certainly proven correct. The other thing we watch, of course, is Japan. And I do think the Japanese yen this morning above 150 again, all kinds of intrigue in Japan, which is very difficult for Westerners to penetrate, of course. But Japan's critical role in the U.S. Treasury market and their struggles to defend their currency could be the sort of the macro story of the fourth quarter, assuming things don't get measurably worse in the Middle East.
And that's fair. And yeah, you brought up Japan, and they've been recently selling off U.S. treasuries. So it seems like Japan has been willing to, in a sense, kind of help out the U.S. Kind of, I don't know, not necessarily like fall on their own sword, but they're essentially doing this to protect themselves. At least that's how I somewhat understand it. So I guess what is the impact of this Japan starting to sell off U.S. treasuries on the overall, I guess, U.S. market?
Well, again, if Japan is selling U.S. treasuries, that doesn't help the U.S. Of course, it makes Powell's challenge all the more difficult because that will lead to a spike in rate. If Japan is no longer going to be the marginal buyer of U.S. treasuries, and then that means there's one less bid in the market, and that means interest rates are higher. Now, it does some of the work for Powell, of course, but that there's a pretty distinct and negative correlation between what the 10-year is doing and what the Nasdaq is doing on any particular day, and that correlation tends to be negative. If rates are spiking, Nasdaq sinks, and vice versa. How long that correlation lasts remains to be seen. But that's why we point out that Japan is a big unknown, because if they have to sell more and more of their holdings to defend their currency, and 150 is kind of like a line in the sand for them, then it could spell an interesting challenge for the U.S. policymakers.
Yeah, and that's that doesn't seem great on the surface, to say the very least. But I want to get back into the I guess the oil and gas industry, right? Because it seems like that was, I guess, a big topic of conversation at the beginning of this year, and obviously due to what we lined out, obviously geopolitical factors and things like that towards the end of this year, but. I guess, how is that developing on the U.S. side of things? Like, do you foresee the U.S. trying to become more independent? Obviously, you've been very vocal about the ESG policies and, that aspect of things. And, it seems like obviously the current party has been deploying all the reserves. It's, there was something viral going around that said we only had 14 days left of our current oil reserves, which has proven to not really be true from my understanding. But I don't know if you could provide a little bit more clarity on that and kind of where we're going.
Sure. So there's a bit of, you always have to be mindful of what you're reading on Twitter, for its validity. So the SPR, let's talk about the SPR first, and then we'll talk about U.S. energy independence second. The SPR was created at a time when the U.S. policymakers believed that the country had reached and was on terminal decline. It had reached peak oil production and it would never recover. And on the heels of the oil crisis in the 70s, the SPR was conceived and built and filled at a time when policymakers felt like the deficit that we would need could never be filled domestically. And so that's an important context to consider now. Of course, we've argued that the Biden administration for political reasons, did empty roughly half of the reserve. That's a scandal. It shouldn't have been. It shouldn't be legal. But the U.S. is actually a net energy exporter today. We're a major producer of oil and especially natural gas. We still import oil and we export oil because of a mismatch in the grades between the types of grades our refinery fleet prefers to run versus the types of grades that are being produced in the Permian today, where most of the growth is. But the U.S. is the world's largest producer of oil. It is a net exporter of refined products, and so things like the number of days that we have in the Strategic Petroleum Reserve is highly misleading, because the U.S. could always halt exports and keep many of these refined products at home, and so on. Now, of course, it would disrupt the market and come with all other second and tertiary consequences. But the need for the SPR is not what it was when it was built and conceived and constructed. That doesn't make it any less of a scandal that Biden emptied it. But we think that that era is over. We don't think they'll ever really refill it. But the days of 1 million barrels a day, putting a cap on oil price flowing out of the U.S.'s SPR are probably behind us. That doesn't necessarily mean that China won't take the baton from us. They have a very large Strategic Petroleum Reserve themselves. And unlike the U.S., they are in fact deficit consumers of oil. They don't produce nearly enough of oil for their domestic needs. And so they are keenly interested in managing the price of oil as well. And so we shall see. But there is that. And then there's a final sort of cap to the price of oil that the market perceives, which is that the fact that Russia and Saudi Arabia voluntarily cut so much production from the market that could very easily come back online. That there's probably some concern that, but there's a sort of a sweet spot price for oil where both producers and consumers like to be, which is in this $70 to $90 range. In these ranges, the oil producing countries can make a lot of money. They can fund their domestic needs, and the oil consuming countries aren't in such stress that they enter into a recession. And so I think both sides of the equation are comfortable with this equilibrium price of around 80 plus or minus $10 a barrel. And we saw it as soon as it shot above 90. It was brought right back down again. And so I think there's probably a fair bit of tug, that equilibrium price. But the U.S., this 14 days or 19 days, I think it was, that's not very meaningful in the context of today.
Yeah, and that's understood. Yeah, and I appreciate you kind of, I guess, shedding some light on the SPR and kind of that aspect of things. But obviously, because the U.S. is like a net producer, and you said that the sweet spot is where we're kind of sitting right now. Obviously, the doom and gloom is what gets the clicks, right, at a certain point in time. But there has been, obviously, what we said earlier. You got to be cautious about what you're reading on Twitter and some of these other sources. But it seems like there's, I guess, growing fear that, Brent crude is going to go over $100 a barrel. Do you ever foresee that, I guess, occurring maybe in the next, 6 to 12 months? I'm putting you a little bit on the spot here, a little bit of prediction.
But... Oh, of course. I think oil could go to $200 a barrel in the next 6 weeks if the geopolitical world explodes. But look, there's also another very dangerous trend that we even hesitate to write about sometimes because you don't want to give people any ideas. But with the destruction of the Nord Stream pipeline, and now the destruction of this pipeline in Finland, this underwater natural gas pipeline, we are beginning to normalize the wanton destruction of critical energy choke points as sort of international tit for tat here. And that's very dangerous. And so you can imagine, attacks on refineries, attacks on critical oil pipelines, foreign terrorists infiltrating the U.S. and blowing up key infrastructure. Like, if you think about 9/11, as terrible as it was, like the economy can continue to function with the loss of the buildings and damage to the Pentagon. But if you target the right infrastructure, there's a lot of attacks on transformers and the power grid. A coordinated assault with several dozen terrorists blowing up the right choke points could really put the country in a lot of hurt, and that in turn could trigger a massive military response and so on. And again, like Senator Lindsey Graham, it should be should be ashamed of himself for going on TV and demanding that we proactively strike the oil refineries of Iran as punishment. That's dangerous talk and could lead to self-fulfilling prophecy. So let's just take that forward. Who is the number one provider of oil to China today? Well, it's Iran. They just overtook Saudi Arabia. Do you think if we blow up Iran's oil, first of all, what happens to the price of oil? Second of all, China looks at Taiwan and looks at its current reserves and decides that maybe it's go time because they're never going to have as much oil as they do today. And so next thing you know, dangerous talk by a warmonger senator in the U.S. leads to a cascading series of dominoes, and we wake up one day and oil is $200 a barrel, and the economy is sent into a tailspin. That's totally possible. I don't think it's likely. I mean, I think our base case is range bound between 70 and 90. I don't see it going much lower than 70 or much higher than 90, and unless something catastrophic happens, in which case it could pierce both. It will spike and then collapse as the economy gets crushed in between. And the one thing that's really dangerous for the economy, of course, is volatility. The absolute value of the price of energy, given enough time, can be worked through the supply chains. It's the volatility where people get stuck. If you buy oil and you transform it into something and you pay for it when it's high and then the economy collapses, then you get in big trouble. And the volatility is really what kills people.
Quick commercial break to bring you some of the dopest Bitcoin merch in the game. That's Hodler's Official. That's HODLERS official.com. You can go and get yourself a black jersey like I got on right here, or a white one where you can get the Genesis pack with the 09 on the block, repping Satoshi, repping the #1 guy in Bitcoin. And you can get yourself the best merch by going to hodlersofficial.com and using promo code GREENCANDLE for 10% off your entire order. That's 2 handfuls of percentages, ladies and gentlemen. 10% off. You can use the rest of that to purchase more Bitcoin or do whatever you want with it, but I'm saving you some Skrilla Manila. So go ahead and get yourself one. I prefer the black, but if you like the white, I don't mind that either. All right, now back to the show. Gotcha. And yeah, I mean, obviously there's it seems like the current party in office is not doing, I guess, a great job when it comes to, the relationship, especially with China. You recently published an article about, the geopolitical warfare. And one of the things you highlighted was the graphite production and how just astronomical China's production is in the global share of things. Obviously we've been talking about, oil and the energy markets. But I guess what is the impact of, China essentially having a monopoly when it comes to graphite production? Like what if the tensions rise and essentially, China essentially cuts off the US, like how would that affect us going forward?
Yeah, we wrote a piece called Geopolitical Warfare, where we made an observation that is, I think, evident to people who have spent a fair amount of time in industry, but perhaps not so obvious to those who have not. This is something we've grown up with. So in theory, of course, cost differences between producers should be driven by things like technology and innovation and so on. But in reality, costs differences between commodity producers and mature industries are almost always driven by the answer to one simple question, which is, how much are you allowed to pollute? And that sounds like a weird question to ask, but transforming materials, the key driver of the cost is how do you handle the waste and the pollution that comes with it? And China, as a strategy, allows its domestic producers to pollute, recklessly, which allows their domestic producers to have a much cheaper cost, which allows them to take market share. And so the chart that we showed in the piece for graphite is indistinguishable from any of a dozen charts that we could have picked. China, as a general rule, if a commodity is deemed critical and producing it is environmentally taxing, China inevitably comes to dominate it. And in that piece, we argued that if there's a certain subset of minerals that we deem to be in the national interest to produce domestically, there's no getting around the fact that we should be proactively compensating producers to impose the strictest pollution standards that we have come to expect in the West. But we can't mandate that they do that and then expect them to be able to compete with China. If your competitor's idea of a water treatment plant is a pipe to the river, the Western producers are never going to be able to compete on price. And so that's why China controls dominant share in gallium and germanium and the processing of rare earth metals, which are needed for all manner of electronics and motors and so on. They're used for magnets. China has 100% share of that. China has 100% share of the polysilicon ingot and wafering parts of the supply chain. So even though we make polysilicon here, we have to send it to China for processing. We should get together as a country. We should get serious about our national security needs from the manufacturers of commodities. We should make the list of the things we want to make here, and we should support the manufacturers willing to do it, and by giving them money. This goes against what conservatives would say is free market economics, but in reality, the free market fails in at least three regards. It fails to account for environmental damage. Given the freedom to do so, companies will pollute in the chase for short-term profits. That's just undeniable. It fails to account for national security interests, as we've just described. So there's all kinds of failure modes of the free market. And in this case, because of these national security concerns, we should get serious about, look, the first step in all of this is we should admit that we're in an economic war with China, and we should behave accordingly.
No, 100%. And that's what really worries me, obviously, with all of, the geopolitical tensions, is that, it seems like it's been kind of, I guess, teetering on the edge here of the US and China kind of, I guess, I don't even know, like, essentially, like, who's the real power of the globe? And obviously, the US has been almost shooting themselves in the foot with all these ESG policies, which has made us more reliant on China, as you've outlined here, right? I mean, you need a bunch of these earth metals in order to make a lot of the electronics, right? And we're trying to move towards just, strictly electronic vehicles, trying to go to more environmentally friendly. But in a sense, everything needs to be produced and shipped over there, which would use, gasoline. And it just seems like kind of, I guess, all backwards in a sense. So, I guess, has there been somewhat of a shift away from the ESG narrative that seemed to be kind of at the forefront of, everybody's mind back in, 3-4 years ago or so?
It's not even ESG, though. It goes well beyond ESG. So just take magnesium, for example. The entire automotive supply chain depends on magnesium because it, enables lightweighting of vehicles and aluminum composites and so on. China, we used to make an enormous amount of magnesium in the US. It was done in Freeport by a company known back then as Dow Chemical. And it's an environmentally dirty thing to do. And given the relatively strict pollution requirements that come with permits in the Western Hemisphere and the developed nations, it became impossible for Dow to compete against foreign competitors who were not held to the same standard, and they shut the plant down. The U.S. produces no magnesium now, and China basically has a global monopoly on it. And that tiny material goes into all manner of important supply chains, ESG or not. Chips, semiconductor chips. These are in Taiwan, and this is a big driver, of course, of much of the tension between the U.S. and both China and the U.S. are in this arms race to try to develop their own domestic supply of high-end fabrication factories. But that actually is a very, very challenging thing. It's more of an art than a science. And the most important people in the world are the lab technicians that know how to make the semiconductor factories run in Taiwan. That's a very difficult to replicate. It's a moat, really. And so if China and Taiwan do embark on a kinetic war, there's huge threats to the entire economy, again, well beyond ESG. ESG has made it worse, of course, because China has maneuvered to monopolize the specific choke points, specifically solar and battery materials and rare earths and so on. And graphite is just a warning shot to the U.S. that it can and will use such power if it perceives that the U.S. is being too bossy with it. And so that's why we say the first thing we have to do is realize that we're in a war, and then we need to fight accordingly. But this is not a, if China is making all of our weapon systems, then who has the leverage? Like, it's very, very simple, Brandon. Like, you and I can say it, but like, because we run a free market economy and because our companies are beholden to Wall Street for quarterly reports, you lose those market inefficiencies. Those externalities are improperly priced. The environmental degradation is improperly priced. The national security interest is improperly priced. No individual company is optimizing around national security. That means we must have the government to do it. And then finally, the last point I should say is GDP is a particularly terrible measure of the value of having back integration into these energy and commodity supply chains. They're treated as equal to the services industry, where the number of people working at movie theaters is counted as the equivalent of the value, quote unquote, assigned to the oil that we produce. They're just radically different. And GDP does a very bad job of measuring the importance of certain sectors. This was proven when Putin first invaded Ukraine, and analysts in the West were sort of poo-pooing his geopolitical power because he, quote, has a small economy, and they were using GDP as the measure. As we found out, he has a substantial share of the export market for critical commodities, and GDP is a terrible measure of his geopolitical influence, much to the chagrin of policymakers.
The energy in this podcast is brought to you by Sovereign, the .1 energy drink in the game. You can use promo code GREENCANDLE at sovereignenergy.com. That's SVRN.com. And you can get 10% off your entire order whenever you put in promo code GREENCANDLE. And on the side, they've got a pull tab. You can pull off this tab for every single one. Scan it. They got a QR code in each can, and you get sats back too. So, woo! Now go get yourself some. sovereignenergy.com, promo code GREENCANDLE. All right, back to the show. Yeah, and I mean, you're nailing all this on the head, it seems. And I mean, it is a very drastic situation, and it seems like, I guess China has the in a sense, like a leg up on us just because of everything that we rely on them for. The one thing that we do is spend a shit ton on, defense spending. And that's been always the narrative, is that the US, no matter what, like, everybody's in a sense almost afraid of the US. And, because we, one, control the monetary policy and have the strongest military in the world. Obviously, we saw like that fear kind of wane when, we left Afghanistan the way that we did. And, essentially, it got taken over right away. I believe at less than a week after we left. So, do you think that is, I guess, playing in a factor that our military, was once was, I guess, known as the most powerful military in the world? Maybe it still is. But I mean, that fear of being the most powerful military in the world is, in a sense, just kind of waning.
Well, if you want to freak yourself out, head over.
Yeah, that's what we're doing here.
No,
right?
let me I'll send your readers to a good friend of ours, a fantastic Substack written by Matt Stoller called Big, bignewsletter.com, or just Google Matt Stoller Big. And he writes about monopoly and monopoly power and how damaging it is. And he put out a piece on October 20th, which, after I read it, you just have to put it down and shake your head. It's called "Why America is Out of Ammunition." So as it turns out, we're running out of bombs. We're running out of ammunition. Why? Because the companies that have served the military, that people would call the sort of military-industrial complex, has become ever more concentrated in fewer and fewer companies. They're fat and happy living on the hog, and they are allocated money by the Pentagon, and then they buy back shares instead of making weapons. And it's really a scandal, a corruption, grift scandal of epic proportions, and makes one wonder just how strong, quote unquote, the U.S. military actually is. It's a really stunning piece. And Matt is a nonpartisan, by the book, great reporter who only researches and writes about one issue, which is the damaging consequences of monopoly power. And I really respect his focus, because this is the issue that he is most passionate about. But when you read that piece, it's pretty incredible and scary. Like, for all this money we're spending, how could we be out of bullets? Where's it going? Staggering.
Yeah. And I mean, back to, all the money that we're spending, I believe that it came out yesterday, or maybe the day before we're recording this on October 31st, that the U.S. is looking to borrow $776 billion in this last quarter. So, I mean, it seems like, no matter what, government spending keeps on increasing and increasing. And we're essentially either sending that overseas to the Ukraine or other places. But, in a sense, like, I guess, what is the overall like outlook for the U.S. bond market, in a sense? I know we've kind of touched on energy and, the rising geopolitical tensions, but, in a sense, it seems like the overall just like monetary policy of everything, the United States as it stands, we're teetering on the edge here of a lot of doom and gloom. Is there any positive outlook that we can find in this, or is the U.S. bond market essentially kind of signaling that the crash is coming?
Boy, it's okay. I think long term, of course, we are deeply optimistic about the U.S. It has incredible assets, like unbelievable assets, great institutions. But in the near term, it is kind of scary to look at things. Yeah, we're going to run what, like a $2 trillion in deficit during a time of economic growth. What happens if we hit into a recession? What happens if the stock market collapses and capital gains taxes stop flowing in? It's pretty, many people believe we're on the cusp of what is known as fiscal dominance, where keeping up with your interest payments causes you to go into a debt spiral. That's often associated with emerging markets, not with the gatekeeper of the world's global currency reserve and the owner of the strongest military. We have $33 trillion in debt, a big chunk of which is rolling off in the next 5 or 6 years. And if interest rates stay this high, anybody can do the math of 33 trillion times 0.05. That's, to a rough approximation, 1.8 trillion in taxes, in interest payments alone. Sorry, 1.8 trillion. I'm old enough to remember when $1 trillion was a lot of money. Like, it's staggering. I mean, if we could go back to the 1980s or bring somebody forward from the 1980s and they would see our fiscal situation, it would be unrecognizable. It's just crazy. I don't know what to say. Yeah, it feels like the wheels are spinning. And look, for all of this talk about the Republicans, and we wrote a piece called Minority Report where we analyzed the potential geopolitical and domestic implications of McCarthy's ouster from the speakership. This new House Speaker, well, the first thing we're still contemplating, sending tens of billions of dollars overseas. Why don't we fix our bridges and roads and dams here? But we're spending money as though there are no consequences, and we are, I think, entering a very, very dangerous period.
Yeah, and it seems like the current party in power is, just really adamant in helping everyone overseas. And obviously, we're recording this like Q4 2023. There's an election coming up. Obviously, there's a lot of potential, things that ramifications that could come to that. A lot of political jousting is about to take place, to say the very least, in the next 6 to 9 months before this election. So, in a sense, with that, like, obviously, the politicians are going to do what benefits the politicians first and foremost. And it seems like, there really isn't anybody that I guess is on the American people's side. But I guess, like, what's the solution for all this, right? I mean, like, it seems like we're essentially going to, I guess, outbreak here, and there's a lot of problems domestically, but it seems like the political people, the powers that be, are more concerned with what's going on overseas. So in a sense, like, yeah, I guess, like, if you were in power here, what would you do in order to, I guess, kind of flip things on the head and try to help us domestically?
It's funny you should say that, because we have 2 subscription tiers at Doomberg. Our regular subscribers who get all the articles, and then we have a pro tier where we publish a monthly Doom Zoom, and we just put out yesterday our October Doom Zoom. It was titled "If Doomberg Were King." And so we go through in 65 slides exactly what we would do. And of course, to us, all roads start with energy. And so we would totally change our focus on energy. We would develop an optimized equation where we look at what we call the fundamental trade-off equation of total net energy produced divided by impact on the environment. And we have to consider both. And that's the equation that we would try to drive higher and higher and higher. We would, revolutionize our nuclear sector. We would fire everybody who works at the NRC and build it over from scratch. We would make the head of the NRC a cabinet level position. We would encourage the domestic drilling of oil and gas with good pollution controls and developing optionality around carbon capture and sequestration. We would put a moratorium on offshore wind and cancel all of those projects. We would maintain our existing hydroelectric dams. We had a whole series of policy proposals that we would recommend if we were king. And in our view, if you produce an enormous amount of net energy abundance, then that comes with it cures to your economic problems and cures to your geopolitical weaknesses. And so this is something that we've given a lot of thought to. Those listening who are interested, you can become a Pro Tier subscriber and get the full archive of all of our presentations that we've been doing. We do one of these a month on average, where we do a deep dive with, PowerPoint slides and a full recorded presentation. So we just did that yesterday.
Yeah, I guess a little peek behind the hood. I'm not gonna lie to you. I have the Doomberg some Substack open in one of these tabs, so I did see that before when I was preparing for this interview here. So I was kind of curious to see how much I could get out of you. But I mean, I did have a feeling that it was gonna revolve around energy because obviously you guys are great when it comes to the energy markets and things like that. And energy is the lifeblood of the society here too. So obviously we've talked a lot about that, but the monetary policy and that aspect of things has really changed the overall landscape of everything too. So before I let you go, I want to kind of take a dive into Jerome Powell and the Fed, because it seems like there was, I guess, conflicting narratives when it came to his job and what he was doing at the beginning, because obviously he raised interest rates at such a dramatic pace. Everybody thought that something would break. You even mentioned it earlier, and to his credit, nothing has really breaked. Maybe like a couple big bank failures, but from all accounts, it seems like those the risk management at those banks weren't exactly up to some high standards. So with the higher for longer, that has been his mantra. How do you, I guess, I'll just leave it broad. Like, what do you think of the job that he's doing? Essentially, I guess, pulling the only lever that he can and pulling it as strong as he really can when it comes to, keeping interest rates as high as he has.
So I would say it's hard to judge a man who is in an impossible job. Seems like an intelligent guy, seems like a patriot, seems like he's generally trying to do the right thing. But ultimately, he's been handed, 30 trillion in debt, deficits as far as the eye can see, and raging inflation. And to be fair to Jerome Powell, this is decades in the making. And so to expect one individual to make a meaningful impact on what is just undeniably a trajectory is a little unfair to Jerome Powell. And of course, we like to develop scapegoats, and history likes to pick winners and losers and so on. And so that's fine. But I would say, given the hand he was dealt, when I listen to the man speak and when I read the notes, it seems to be trying to do his best with the information that he has. And as you say, interest rates are higher, inflation is down, and the economy hasn't broken. So by those measures, full credit to Jerome Powell. It remains to be seen. It's a bit of a TBD. As you may recall, in the 08-09 financial crisis, a lot of bombs went off, and then there was a quiet period before, everything really hit the fan. And the big question is, we've pulled the pin, and the grenade hasn't gone off. Is it a dud, or does it just have a long fuse? And the longer it goes, where nothing breaks, and the economy has a chance to adapt to higher interest rates, I guess the argument would be that the grenade was a dud. But we shall see. There is countervailing forces. There's real forces that are driving the economy. There is a distinct effort to onshore and reshore and nearshore to reroute supply chains out of China and other high risk, areas. There is continuing technological breakthroughs in the energy sector. There is a global nuclear energy renaissance that's beginning to unfold. The U.S. does produce an enormous amount of natural gas, which is selling for dirt cheap levels today in the country, which gives us enormous manufacturing advantages. If you could source your energy domestically and price your products at global prices, and natural gas is a big input into your manufacturing facility, and it is for many manufacturers, then you're at a huge advantage. And so there's lots of things going well for the U.S., and it's important. Even Doomberg, it's important for us to recognize those things. As analysts, you want to get it right. You don't want to be, just doom and gloom for the clicks, as you said earlier. So, what does the U.S. have going for it? Natural gas out the wazoo. We have so much of it, we don't know what to do. We burn it in the field. That's how much we have. We have, again, we have more refining capacity than we need domestically. We have enormous systemic advantages like deep water ports and extended river systems to move products around cheaply. And we have amazing farmland and soil. We grow more food. We burn food as fuel, as a luxury, as an ESG luxury. That's how wealthy we are. We have universities where every brilliant person in the world is trying their best to get in, and our broken immigration system is hampering it. We have a lot of tailwinds. We have so much tailwinds that we are able to tolerate a political leadership class that is so corrupt and so stupid and so ineffective at historical levels. And yet most of us are living pretty decent lives and wouldn't know the difference. That's remarkable. Imagine how powerful we could be if only we had King Doomberg in charge. Then life would be great.
Yeah, I like that. I like that, man. But I know I did say that was going to be like before I let you go. But I mean, obviously we've been talking about the Fed, the monetary policy. I'd be remiss to not ask you about the proposal that BRICS has made. And I guess the growing issue when it comes to the dollar and kind of that reign of power, right? I mean, we've even had Robert F. Kennedy Jr. here domestically say that he would back the dollar with more hard assets, right? I mean, and whether that's gold, real estate, he even mentioned Bitcoin as well. We've had the BRICS currency, or the BRICS propose a currency, whether it is a cryptocurrency or whatnot, remains to be seen. But I guess, what do you take of the U.S.'s reign on, like the global currency, the global reserve currency power? Do you think that is waning in a sense, just because of, one, the rising geopolitical tensions, and two, kind of, I guess, the actions of Jerome Powell to leave, essentially like killing the global or the offshore dollar market, excuse me.
I would say the strength of the US dollar system is pretty robust. We would fade near-term alarmism in this regard. In the long run, and in the worst case, I think we could see a bifurcation, but the G7 countries, the developed world, are in the US dollar system to stay. That is a significant amount of global GDP. At the margins, are people frustrated with the fundamental problem, as Luke Groman has, I think, correctly identified for years, really comes down to energy again. So countries that are stuck settling their energy purchases and sales on the other side of the equation would like to get out from under the US dollar as the currency in which these commodities are marked, and treasuries as the excess reserve holding entity for producers of excess electricity. And we're seeing some of that certainly at the margins. And that will begin to undercut US geopolitical power. And this is a knowing strategy of China that they have been embarking upon since the global financial crisis, and when Ben Bernanke basically broke the commitment of US Fed chairs to make the US dollar quote as good as gold for oil. And this is, again, something we've lifted completely from Luke Groman's great work, and always happy to give credit. And so in the financial crisis, Bernanke had a choice. Does he rescue the domestic market, or does he preserve the US dollar as the reserve currency and as basically the equivalent of gold for energy transactions? And what I mean by that is, when you sell energy and you don't have a place to put it, you store it in US treasuries, because the US dollar would be as good as gold for oil. And you don't put it in gold. Well, the reason why the BRICS developments are of such keen interest to many people on financial Twitter is because of the tie-in to gold returning to its role as a reserve, a neutral reserve asset. And with gold spiking above 2,000 and people watching the price of gold in Shanghai versus London, it's certainly very interesting, and we've written about it, but we think this will be a gradual trend, not necessarily like how Afghanistan fell apart all at once. There won't be people clinging to planes as crates of US dollars are flown out of hostile territories.
Yeah, and I mean that makes complete sense, right? I mean, I subscribe to that theory as well, that it's going to be like a slower transition away from the US dollar, if it even gets to that point. Obviously there's a lot of people who think that it's going to, I guess, flip on its head, but in a sense, yeah, go ahead.
There's actually reasons why that would be a good thing for the US, including it would give us the opportunity to rebuild our manufacturing base. I mean, one of the unfortunate consequences of being the reserve currency is the need to produce all of these treasuries. And therefore, what happens as a consequence is we have our manufacturing base hollowed out. And if we're going to step away from being the reserve currency in some settings, that does open up the possibility of a weaker US dollar, leading to advantaged manufacturing and so on, and making the US national security issue a bit more robust. And in fact, Groman does argue that the military would like to see the U.S. lose its reserve currency position because it is more concerned about robustness in its critical supply chains. And so there's arguments to be made that a slow chipping away of this is actually by design and positive for the U.S. And we would be inclined to be supportive of that view.
Wow. Okay. Yeah. I mean that's interesting. I'll have to check out that piece on that Luke Groman wrote, because I thought it would be the opposite. Obviously, I thought that was I guess the power or the ability of the U.S. to I have the global reserve currency was essentially a big part why we're one of, I guess, known as the most powerful nation in the world, or at least for now. So that's I guess I recommend everybody to go check that out, because I definitely will be.
Let me give a proper plug for his work, because again, I'm always happy to share great work. You can find his stuff. It's just Google "Forest for the Trees." It's not a piece. It is literally a decade's worth of writing. He publishes a weekly note called Tree Rings. I should say it's a little more pricey than Doomberg. It's 3 times the cost of Doomberg. It's meant really for, I think his main products are institutional, and then he has this retail product that I subscribe to, and I read it every Friday when it comes out. Forest for the Trees, Luke Groman, you'll find it if you just Google that. But instead of that, you should probably start with Doomberg, get the appetizer, and go to doomberg.substack.com and become a subscriber there. And then, after that, if you can still afford it, head over to go see Luke.
Yeah, no, exactly. And I was just going to give you a chance to plug your stuff. But yeah, I highly recommend Doomberg Substack, whichever tier that you seem fits you. Unfortunately, I couldn't get the why Doomberg or King Doomberg full 40 slide for everybody here to give a little preview. But I do appreciate you giving us a peek under the hood and giving us some of the great nuggets from that. But outside of the Substack, where else can everybody find you? Or I guess track on what you guys are doing?
Yeah, that's the main place. We've left Twitter and focus exclusively on the Substack ecosystem. You can find us at doomberg.substack.com. From there, you can find all of our articles. You can find our pro tier with that presentation. And you can find a special dedicated webpage for all of our podcast appearances. And this one will be put up on that link. And notes, which is the mild Twitter knockoff that Substack is developing, where we do any of our sort of daily posts and updates and stuff over there. And that's kind of a fun little ecosystem. It's much friendlier than Twitter. It's a little smaller, a little more intimate. A lot of great writers on Substack, a lot of really great reporting happening on Substack. We're big fans of the Substack team. And so, doomberg.substack.com. And look, Brandon, it was great. Time flies by every time we talk. Looking forward to a third appearance soon.
Yeah, for sure. So Doomberg, thanks so much for coming on, and thanks for your time. And everybody check out his Substack, to say the very least. Check him out on Substack Notes and anywhere else that he just previously mentioned. And Doomberg, thanks so much. Thanks so much for tuning in to this great episode. If you enjoyed this one and you want some more content, click on the link right here and check out my latest interview with Tom Luongo. We get into it all. If you've known Tom, he's a wild one, so stay tuned. And if you found some value in this podcast, please smash that like button, hit that subscribe button so you get notified of the next videos. All right, I'll catch you at the next one.